Hello and welcome to the show. It is great to have you with us. Just a few weeks ago, we saw the biggest jump in oil prices in 2 decades after the drone attacks on Saudi Arabia's oil infrastructure wiped out 5% of the world's oil supply. So why are oil prices lower now than they were before the attacks? Who better to ask than Bart Melek? He's Global Head of Commodity Strategy at TD Securities. Good to have you here.
Great to be here.
Let's start with a chart, and we can bring it up in terms of what's happened with crude, that massive spike up. But I think what people want to know is why are we back down below where we were when the spike started?
Well, I think main reason is we are concerned about a significantly slower growth environment globally. And that means that very likely the estimates of global demand growth next year will be somewhat smaller than the consensus thinks. Right now, most key agencies like IEA and others are looking at 1.3 million barrels of new demand next year, and that's per day, of course. Given the fact that Europe is very much headed for a industrial recession, at least, Germany is one print away from showing an actual de facto recession. U.S. manufacturing activity has slowed down, and it has also brought down just consumption broadly, as manifested in the non-manufacturing ISM figures. China is below 50 in terms of manufacturing PMIs. It is probably a good bet to say that demand will be less robust. And at the same time as demand is likely to be weaker, we are having non-OPEC producers increase supply by 2.2 million barrels a day, of course led by U.S. shale. And when you aggregate those numbers and model them, chances are you are going to get a surplus in the first and second quarter of next year. We estimated well over 1 million barrels.
What about OPEC production? I mean, you said non-OPEC is spiking up, but OPEC?
Well, OPEC has been very good at keeping discipline. But if demand is sharply lower, and if non-OPEC producers ramp up supply, I'm not sure that there is anything OPEC is willing to do that's severe enough to bring this market into a balance or a deficit that would rally up the prices. So at this point, people are unwinding their long positions and deciding that the risks are to the downside.
So let's talk about the risks to the downside. How down is it?
Well, of course, economists will always say, and strategists, it all depends. But I think we could see 4 handles in the near term. OPEC is meeting in December. We'll see what they say. But chances are they will want to commit to 500,000 barrel cut, and that is unlikely to be enough. And I'm quite convinced that for now there isn't a consensus to do more, because what would likely happen is they would lose market share and the price would still go down, and that's probably not accretive for them.
What about, you talk about the fact we've got an industrial recession in some parts of Europe, manufacturing recession, it looks like in the States. What if it tips over into a broader recession? What is that going to mean for oil prices?
Well, it will most likely tilt them even further down, mainly because it would mean that things like transportation are down, so people would likely travel less recreationally and for business. You would have, of course, less shipping from Amazon and such. So the transportation sector would probably decline. Everything from power as well. So it would cascade lower, and then we would have probably larger, mismatches between supply and demand.
Let's go to a bit more of an optimistic story, I think, for investors, from oil to gold. And you're seeing, I think, gold trading right now around the $1,500 level. Why have we seen this run up since June? I mean, it's weird to see, I think, gold and the markets both move up at the same time.
Yes, and it is quite unusual. Typically, you would have them act in opposite directions, and we've seen that. But I think several things are happening. The market again started to believe that the U.S. Federal Reserve and other central banks will keep yields dropping. Certainly we've seen the bad prints in the ISM manufacturing and non-manufacturing in the U.S. shift the probabilities of an October rate cut from 34% all the way to 80%. That helped gold. But of course, this narrative has been going on for a while. What does it mean? Well, we're seeing a race to the bottom in terms of rates. And that is coming from Europe. We're seeing $16, $17 trillion, depending on what week you look at, of negative yields. And as people fight for yield preservation, they will move into our markets, and that includes the Canadian market, the U.S. market, and compete the price upwards and reduce yields across the board. And that means there is a low opportunity cost of holding gold. And with yield curve inversion means that there is really no arb in taking material from inventory and selling it into the physical market. So we are in a very interesting time historically where the interest rate environment keeps inventories where they are. It reduces opportunity cost of holding it. And I think increasingly we are seeing central banks. The last time we've seen China yet again buy gold. Last year we had central banks buy about 640 tons. That looks like it's going to be beat even further this year. So we're seeing a constraint with interest rates preventing that flow from inventory into the broader market. It's very much an interest rate story.
So then what happens? I mean, where does it go from here then? If all that holds true, what you're saying, I mean, are we going to get gold up to the $1,600 level?
Well, that's our forecast. We're looking at an average quarterly price by end of next year, by last 3 months, of about $1,650. So from a trading perspective, this could go $1,700 or higher. Our view is that we're going to see one more rate cut this year from the Federal Reserve and most likely 3 more next year. There could be more. It will very much depend on how quickly the economy is sliding. And it was very interesting a little while back to have the IMF talking about a synchronized downturn in the global economic activity, which could very well force rates even lower and central banks be a little bit less cryptic in what they're willing to do on the monetary stimulus front.
Bart, we're going to have to leave it there. Thanks so much.
My pleasure.